Good day, friends. This is S. Venkat, Founder Director at My CFO. Welcome to one more of My CFO's 1-minute videos. This particular video is targeted at all of you entrepreneurs who are looking to get a valuation of your business done with an aim of either exiting the business totally or possibly getting a strategic partner or a financial investor. So you've done well for yourself, you've been successful, you've scaled up your business, and now you're looking for someone to come in and invest in your company. So what are the three things based on our experience we believe that you should be thinking about while you're getting a valuation from the market? The first thing is the method of valuation. A lot of promoters, entrepreneurs ask us, Venkat, what is the right way to value my business? There is no one clear answer to this. But the good part is if you talk to any chartered accountant, you talk to any valuation firm, they'll be able to tell you that there are probably 4 or 5 methods based on which a valuation of the firm can be done. You could typically have a discounted cash flow. You will be able to have something called a net asset value method. You could have something called a net replacement value method. You'll be able to look at enterprise value through the book value of assets that you're holding. So these are different methods, and it's also quite possible that some valuers would take a weighted average of one or more of these methods of valuation. Do not get too worried if different valuation firms provide different valuations to your business. As you probably know already, valuation is really more of an art than a science, right? So the answer to the question on what is the right way to value your business, you probably have as many answers as the number of professionals that you reach out to. Second, how do I know that the value that I'm negotiating with my investors is the right value at which I should be letting go of the business? Now, the one thing that we all need to recognize as entrepreneurs and promoters is that because it's a business that we have built through our sweat and toil, valuation and particularly exit is an extremely emotive decision. This is more emotional than objective, and whether we like it or not, that's not really going to undergo a change. As a promoter, as somebody who has built the business, your valuation of the business will always be much higher as compared to what the investor will want to put on their table. So how do you decide what is the right point, what is the right midway point between your valuation and the investor valuation? The simple litmus test that I like to adopt is to check with the promoter or entrepreneur that if we were to just reverse roles and if you were to be the investor just for a few minutes, would you be willing to put your money? Would you be willing to put the money of your close friends and family into the business at the valuation that you're expecting from the investor? Normally, an honest answer to that question will tell you what is the right level of valuation at which you will be able to close the deal. The third aspect that you need to be careful about is that valuation is not just a numbers game. Let's understand that an exit typically comes with a number of conditions. Even when you're doing a total exit, there are non-compete clauses that you need to be aware of. If you're doing a partial exit, then things are a lot more complicated because you need to co-work along with the investor to run the company and help him to make a return on his investment. Now, this involves decisions around what kind of matters need to come to the board for decisions. What kind of matters are reserved only for the promoters to take a call? What happens if there is a need for further capital infusion in the company? Is it possible that only one partner gets diluted out? What happens if the business does not generate enough returns? What are the rights the investor gets to drag you along and force you to sell your stake to somebody else? When you think about an exit, don't just think about it from the prism or the lens of valuations or monetary parameters alone. There are several non-monetary, non-financial implications of an exit that you've got to be extremely careful about. So to quickly summarize, when it comes to valuations and exits, 3 things for you to think about. 1, there isn't one particular method of valuation which is the best or the optimal method of valuation. Second, always try and find a midpoint with the investor. And the litmus test for that is to check whether you, if you were to play the role of an investor, would be willing to put the money at the valuation that you expect the investor to bring in. The third thing to remember is pay a close attention to the non-financial, non-monetary terms in your exit agreement and not just the valuations alone. That's it from us today. Thanks. Bye-bye.